Stock market is going to crash by the end of this year. These are the words by many economists and former US President Donald Trump as well. Today, we are diving into a topic that impacts everyone, a global stock market crash.
The bank stock lost 80% of its value this week, 60% in one day alone.
Management of these banks will be fired. Investors in the banks will not be paid.
Hey there, welcome back to our channel. We'll explore what it is, its consequences, and if we are at risk of experiencing another one. So, let's get started. A global stock market crash is a sudden and sharp decline in stock prices across major markets worldwide. This event triggers several significant consequences that impact investors, businesses, and the economy. Firstly, stock prices drop rapidly and severely, creating a sense of panic among investors. This leads to substantial financial losses for both individuals and institutions as their investments lose value quickly. The loss of confidence can make market recovery difficult. Businesses are also affected as they rely on the stock market to raise capital. The sharp decline in stock prices limits their ability to secure funding, leading to financial difficulties. Companies may be forced to cut costs, lay off employees, or even declare bankruptcy in extreme cases. The broader economy also feels the impact of a stock market crash. Businesses reduce investments and spending, while consumer confidence drops, leading to decreased consumer spending. These factors can slow down economic growth and potentially lead to a recession. To understand how a crash can unfold, let's look back at the 2007 and 8 financial crisis. Here's a brief timeline. From 2000 to 2006, the housing market bubble inflated due to risky lending practices. Banks and lenders offered subprime mortgages to individuals with poor credit, leading to a surge in home purchases and skyrocketing property prices. In 2007, defaults on these subprime mortgages began to increase, causing several lenders to collapse. As more homeowners were unable to make their mortgage payments, the financial stability of many institutions was threatened. By March 2008, Bear-Stearns, a major investment bank, faced severe financial difficulties and was bailed out to prevent its collapse. This was one of the first major signs of the looming crisis. In September 2008, Lehman Brothers, another large investment bank, went bankrupt. This event sparked widespread panic in the financial markets, leading to a significant loss of confidence and further exacerbating the crisis. Later in 2008, the US government intervened to bail out AIG and other major financial institutions to prevent a complete financial system collapse. Despite these efforts, the crisis had already taken heavy toll. The result was a global recession, characterized by plummeting stock markets, frozen credit markets, and widespread economic hardship. The financial crisis of 2007 and 8 demonstrated how quickly and severely a market crash could unfold, with lasting impacts on the global economy. Fast forward to today, and some experts are warning about similar risks. Harry Dent, a well-known economist, has recently raised alarms about a potential crash of a lifetime. He suggests that the current economic bubble, fueled by artificial stimuli rather than natural market forces, could lead to a catastrophic collapse. Dent predicts a decline of up to 86% and even sharper drops for tech stocks like Nvidia by 2025. Just like the 2008 crisis, today's concerns include high valuations where stocks are overpriced, creating market bubbles. The inflated values are unsustainable and could lead to significant corrections. Economic indicators, signs of an economic slowdown are emerging, with rising unemployment and other warning signals suggesting that the economy is weakening. Corporate warnings: major tech companies are reporting disappointing earnings, indicating potential trouble ahead for the sector that has been a major driver of market growth. If a global stock market crash occurs, it could have significant consequences for both India and the rest of the world. Now let's look what would be the impact in India. First of all, market impact. See, Indian stock markets could experience sharp declines, adversely affecting investors and businesses. The immediate loss in market value could erode wealth and lead to reduced investment in the economy. The economic growth might be reduced due to global demand could hurt India's export-driven sectors. Industries reliant on international markets may face decreased orders and lower revenues, leading to slower economic growth. The Indian might weaken against the US dollar, increasing import costs. A weaker would make imports more expensive, contributing to higher inflation and potentially hurting consumer spending. In the global trade, a major downturn economies could reduce international trade and economic growth. As global demand decreases, countries dependent on exports might experience economic slowdowns. Financial institutions worldwide may face instability, leading to further economic stress. Banks and other financial entities could suffer from reduced asset values and increased default rates. The global investor confidence could be severely impacted, affecting markets across all regions. Widespread fear and uncertainty could lead to a prolonged period of market volatility and hesitation in investment activities. These factors mirror some of the issues that preceded the 2008 crisis, raising concerns about the potential for another significant market downturn. So, will a stock market crash happen in the future? Look, it's impossible to predict with absolute certainty. These signs and warnings from experts like Harry Dent suggest that we should be cautious. Economic indicators, high stock valuations, and global uncertainties all point to potential risks. Staying informed, diversifying your investments, and preparing for economic uncertainties can help mitigate potential impacts. Remember, while history can provide clues, the future remains unpredictable. Keep an eye on economic trends and expert analysis to navigate these uncertainties. Thanks for tuning in. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon to learn simply for more updates on global financial news. See you next time.